Good morning, everyone. We've got a nice group of participants this morning. I hope you will enjoy this research town hall. We've got several topics for you, existing research, future research, and we also would like to receive some of your input in how you think about the different topics, the priorities, etc. Today, I have three of my colleagues with me, Matt Letterman, Alan He, and Jesse Pollock. All three of them will actually present part of this morning's presentation. But before I start off, I would like to introduce myself. I'm a new face at FCLT, only started 4 or 5 months ago as head of the research. Before I joined FCLT, I was the CIO at PSP in Montreal, and prior to that, I was at UC Regents and APG in Amsterdam. Over the years, I've published several papers on investments, and I hope that experience will help me in this role, which I'm actually very excited about, and I'm looking forward to to the future. But let us also touch briefly on what FCLT is about. What does it do, and what it doesn't do. The title of this slide actually says it all. It is focusing on the long term to support sustainable and prosperous economies. And we work with basically three different groups. And you can see them in the middle: the asset owners, the asset managers, and companies. And basically what we say ourselves is we cover the value chain from the issuer to the investor. But we do this to ultimately benefit savers and societies, which you can see on the side of the slide. Now, how do we do this? So the next slide actually shows you that. The main purpose or the main tool that we have is research. And it's a broader definition of research because we also develop certain tools, and I will come back on that in a minute. What I would like to emphasize is that we're not an academic institution. The research that we produce is empirical and intends to be practical. The research topics are real and relevant to the C-suite of our members. A lot of the topics actually come from them and not necessarily from us. So there's a clear interaction what to focus on. We do rely on academic insights, but in combination with the insights of our members. So, and that's a great thing about the institution, the members actively participate in the research that we do, and they provide us with a lot of very specific insights. The third part is that we like to influence the behavior where we can. It's not always possible, but where we can, we like to influence behavior. So our research is also action-oriented. Now, if you go to the next slide, you see an impressive group of members. And we're actually very proud of having this group of members working with us. These are very large corporates, very large asset managers and asset owners. And we're really happy that we can work with them on the work that we do. That brings me to the core of our town hall. We've got two flagship products. One is what we call FCLT Compass, and the other one is FCLT Gold Standard. The Gold Standard is where all the research that we do comes together. It's a tool that helps corporate asset managers and asset owners to stay focused on the long term. The current Gold Standard is based on 9 years of research since the start of FCLT. It's a living document, it's a living product, I should say, and we update the Gold Standard as we can because we look into our recent research, past research, and future research to see where we can optimize, where we can further develop the Gold Standard. And we touch on that a little bit at the end of this session when I share with you some of the ideas that we have. That brings me to FCLT Compass. FCLT Compass, on the other hand, provides insights from a macro view. It measures long-termism versus short-termism from different perspectives. The trends and insights from FCLT Compass feeds in our research agenda. And on that point, on this point, I would like to introduce Alan He, who is going to give you a presentation on where Compass is, what it is, and where we intend to go forward with this product. Alan, the floor is yours.
Thanks, Edward, and a good morning, good afternoon, and good evening to everyone on the call. Let's start with the high level. What is FCLT Compass? So as Edward alluded to briefly, in short, FCLT Compass is an annual tally of global assets and really our way to answer the question, how much money is managed in a long-term way? Are the capital markets getting longer term or shorter term around the world? We keep getting questions asking us, how long is long term? For an organization called Focusing Capital on Long Term, that's an important question to answer. FCLT Compass is really our way to measure that and our answer to those kinds of questions. At its core, Compass tries to do three main things. It measures the investment horizon across the global investment value chain. So that's the corporates, the asset managers, and the asset owners, anchoring on a concept of long-term behavior and tangible numbers reported in US dollars and years. Secondly, it tracks this flow of capital and leading indicators of long-term decision-making. And third, we highlight trends in capital markets as well as their overall consequences to the ultimate beneficiaries, the savers, and the communities. It creates the opportunity to drive behaviors. And over this past year, we, for example, took an in-depth look through the households, both in their market participation, allocation, and what it means for their retirement savings. Compass spans a broad amount of data over the past 15 to 20 years since the global financial crisis. That being said, over on the next slide, we'll note that in our latest report, what are some of the key takeaways? What did we find last year? First, we found that capital markets still remain misaligned with ultimate savers' time horizons. There is still that significant gap between these savers' intended investment horizon, which we'll touch on a little later, and the actual horizons that they are saving with and that the global capital markets are dealing with today. Second, we note that global wealth and flows as a whole, it's doubled since 2009. But the investment horizons themselves in many countries have actually not increased, but instead shrunk a little during that same period. And in addition, there's that clear contrast we see between where the capital flows, mostly to American corporations, large American asset managers, and the asset owners that they originate from, much less of whom are actually American. Third, we note that market participation does drive economic mobility, but all that is easier said than done. Actions in the capital markets have consequences. Corporate and investor decisions impact households' ability to meet their long-term goals. This really hits home when households can't meet these goals or are limited in the ways that they try to do so. Broader capital market participation is one thing that's critical to unlocking this economic mobility, securing retirement, and longer investment horizons as a whole. But as it stands right now, it really remains a luxury that primarily only benefits those that can afford it. On to the next slide, we talk a little bit about the first thing that FCLT Compass measures, investment horizons. How, you might ask, do we measure these investment horizons? We have it separate for corporates, for investors, and for households. For the corporate side, it's similar to using a weighted average of your uses of capital. So some uses of capital like research and development, CapEx expenses are slightly longer term investments, depending on sector, depending on region, in the range of anywhere from 3 to 5 years or 10 plus years. While other uses of capital like dividends and buybacks are a little bit more short term in nature and have a shorter investment horizon. Investors are proxied by several metrics like portfolio turnover, duration, and then intended investment horizon, while households are proxied by their own weighted uses of capital. What percentage of their assets do they save in emergency cash into their long-term savings, for example, retirement, as well as housing, real estate, as well as short-term portfolios and tradable securities. On to the next slide. What we did find over the last 15 years of data is that there is a significant mismatch, specifically between intended and actual horizons. This mismatch is really striking. As we see from a household's long-term intentions don't always translate into long-term actions, both between the capital markets and within households themselves. We note here on this slide the gap demonstrated between retirement and actual investment horizons over the past 2 decades. Households have good intentions of saving, retirement, children's education, etc., but their actual allocation and actions can't match that full horizon, and has actually been getting shorter term as we've seen over the last 15 years. Households, in short, they're taking on more risks, acting in shorter term ways to try to hit those goals. Many households then in turn turn into the capital markets for help, say, for example, in their retirement accounts, 401ks. In that sense, it's almost like a device for households to park their money with these capital markets to help. But how many of these households and institutional investors are actually investment horizon aligned? The answer, as we'll see on the next slide, is that not that many actually are. So while considerable difference within households themselves, compare that now to this, the gap between households, sometimes 30 years, 15 years, and those of the capital market participants today, public companies and institutional investors in particular. It's a stark reminder of the disparity in objectives and timeframes, and this mismatch is one that FCLTGlobal is really trying to work to realign. We're not saying let's park everything into a 30-year lockup fund. There's an actual use for short-term savings and short-term goals. That's equally as important. But there's a significant piece of household wealth in the longer-term goals bucket that's just not being met. With that, I'd like to hand it over to my colleague, Jesse Pollock, to talk about some more trends and flows in the global capital market over the past 15 years, as well as some more of the consequences of this mismatch in investment horizons.
Thanks, Alan. Great. So this slide gives us a foundational view of how global capital flows, starting with who owns it, who manages it, where it ultimately gets deployed. On the left, we begin with asset owners. Ownership is broadly distributed around the world, with countries like China, Japan, the UAE, and Norway holding significant shares of global institutional capital. The US is the single largest owner at 27%, but the majority of capital originates elsewhere. And then in the middle, we see that capital largely flows into the hands of US asset managers, who now manage nearly 74% of global institutional assets. And that's a substantial level of concentration in terms of day-to-day investment decision-making. And on the right, we get a glimpse of where that capital is eventually being deployed. Today, US corporates represent 50% of global market value, up from just 32% in 2009. So while the capital may be globally owned, much of it is being routed through the US and into US listed companies. So this slide really sets the stage. Globally sourced capital, concentrated management, and a US-centered deployment footprint. Dynamics we'll explore further in the next few slides. And on our next slide, we're going to zoom into that first leg of the journey, how capital flows from the world's largest asset owners into the hands of top US asset managers. This map brings that previous slide into sharper focus by showing where global capital is coming from and where it's going. Each flag represents one of the world's top asset-owning countries, from Japan's GPIF and China's CIC to major sovereign funds in places like the UAE, Saudi Arabia, Norway, and beyond. And what we're illustrating here is that a large share of the world's long-term capital is flowing into those US asset managers, firms like BlackRock, State Street, Fidelity, and Vanguard, with the first three of those being proudly all FCLT members. These managers based in the US are making investment decisions on behalf of global asset owners. So while management is concentrated, ownership is clearly international. This structure shapes how capital is stewarded, and as we'll see on the next slide, we'll see where it ultimately ends up. This slide shows how global corporate market value has shifted over the past 15 years, and the change is striking. Back in 2009, US companies represented just under a third of global corporate market value. By 2023, they now account for half of the world's total. Meanwhile, the share held by companies in countries like Japan, China, and that broader rest of world category has declined, with rest of world dropping from 28% to 16%. Now, this trend isn't necessarily surprising. The US is home to many of the world's most valuable firms, particularly in sectors like tech, healthcare, and financial services. And it has also historically offered deep liquid markets, strong investor protections, and a legal and regulatory environment that supports business growth. For many global investors, the US has remained a safe and efficient place to allocate capital, which helps explain the concentration we see in both management and deployment. A major driver of this concentration has been the rise of what's called the Magnificent Seven, a group of mega-cap US technology and platform companies, including Apple, Microsoft, Alphabet, Amazon, NVIDIA, Meta, and Tesla. These firms have led global equity performance over the past several years, and their outsized growth has significantly increased the US share of global market value. Their dominance in areas like AI, cloud infrastructure, and consumer platforms has made them key destinations for both domestic and international capital. That said, there is a growing debate about whether this trend will persist. Some view it as structurally durable, while others point to rising geopolitical tensions and shifting US trade and investment policies, including tariffs and other items. Signs that capital market access may not remain static, and that includes both the ability of companies to raise capital globally and the ability for investors to move capital freely across borders. Despite this uncertainty, however, long-term investors will need to maintain a long-term lens. Interim volatility, whether that's driven by these policy changes or market fluctuations, should not obscure the importance of staying grounded in durable trends and fundamentals, especially when you're stewarding capital for future generations. And that brings us to our final topic for Compass, how these macro shifts are ultimately shaping retirement outcomes and household-level financial security. So far, we've talked about who owns capital, who manages it, and where it gets deployed. But it's worth remembering who all of this is ultimately for. At the end of the capital markets value chain are households and individuals, people that are relying on the system to fund things like a secure retirement and just sustain their long-term financial well-being. And this slide shows how well that's actually working in practice. Each chart here represents a country, and what we're measuring is the number of years that households can sustain their current lifestyle and expenditures if they stopped working today, based on their available net assets. This isn't necessarily a formal retirement readiness score, but it does serve as a proxy for financial resilience. It gives us a sense of how well households are positioned to weather a period without income and still maintain their standard of living. And there are some clear contrasts you may have already noticed. Australia stands out as the strongest performer with a high median and a broad distribution, meaning a large share of the population has meaningful savings. Italy also shows a relatively even spread with fewer households clustered at zero. On the other end, the US, China, South Korea, and South Africa all show heavy concentrations near 0 years, particularly for those lower wealth deciles. In these countries, many households simply don't have the financial cushion to stop working. The thickness of each violin plot represents where households are concentrated, so the bulges near 0 in those countries are especially concerning. Ultimately, this underscores why the structure of global capital matters, because the success of the system isn't measured just in market returns, but in whether it supports the long-term financial security of the people that it's meant to serve. All right, so we've just walked through some of the larger trends from this past year's Compass. And to close things out, I'll share just a few quick notes on what's next for Compass. Next slide. Great. So we have some exciting updates coming to the Compass platform itself. The interactive dashboard will be refreshed quarterly to reflect the latest data on investment horizons and capital flows as that data becomes publicly available. Downloadable data sets will also be available for those of you who want to dig deeper into the numbers yourself. With each update, we'll also be publishing short insight pieces that provide additional context to the trends we observe. And our next annual report will be released this December, so stay tuned for that. And if you have any questions, feel free to reach out to either myself or my colleague Alan, and our contact info is right there on the slide. And that will be it for me. So thanks so much for following along with Compass, and I'll hand it back to Matt to keep us moving forward to our next section. Thank you.
Thank you, Jesse. And thanks to everyone who's in the room as well. I've had the ability to look through the audience and see a lot of friends who are with us today. Appreciate everyone who's there. Alan and Jesse have just talked about one of our flagship products, FCLT Compass, and Edward mentioned at the outset we have two, FCLT Gold Standard and FCLT Compass. What I'm going to do now is switch topics and talk about latest research, both new releases and forthcoming releases. We're excited to have the chance to profile one that came out just yesterday on the next slide called the Board Playbook, Winning Strategies for Long-Term Value Creation. Before I get too far into it, I want to acknowledge many members participated in the development of this research, including a number who are in the room. We appreciate all of those contributions. We think that we're able to offer a couple of distinctive things in this project, and particularly with respect to its scope. One is we're talking about long-term value creation in the boardroom around the world, not just in the US, not just in any other one market. Additionally, and I think very interestingly, we're able to do it in the context of both public and private corporations, not just the public corporation. We're able to do that because, as you can see on the first bullet on the slide, we think these boards share a goal here. They share the goal of long-term value creation, and as a consequence, we can borrow practices from one another. There is a challenge, of course. Corporate directors oftentimes feel like they have to follow someone else's playbook, and we're able to help with that challenge by speaking to insights we gleaned in interviews with board directors, CEOs, other experts that allow for the corporate board to create its own playbook for success rather than having to follow someone else's. We think we've reached a pretty distinctive conclusion with this research. In a field of really competing governance dogmas, our bottom line, and I'll quote here, is that the key determinant of success is not adopting a particular governance style, but rather establishing and actively maintaining alignment between the board, management, and strategic objectives as conditions evolve. Let's go on to the next slide. That balance, though, between board, management, and strategy is not constant. It changes over time. And we think, for instance, this is one reason why it's important to have an organization called Focusing Capital on the Long Term involved. There's a time dimension to these challenges. Again, specifically, the balance is between investing in growth and ensuring risk oversight and maintaining operational stability. That language about risk oversight, growth, operational stability can be put more casually in the frame of defense and offense. You can see that on the sliding scale at the top of the slide. And we borrowed that language from our own member CEOs. This is a great example of FCLT strategy at work. Edward mentioned at the outset that we begin with a problem-solving community of CEOs, and that leads into our innovative practical research. This was on the agenda of Summit 2024, and I'll quote there as well from our recap. Executives brought to us the insight that high-performing companies tend to find a good balance between defense and offense, but nearly every board struggles to achieve this equilibrium, and it's the CEO's and the chair's job to seek it. To speak to the slide directly, we think that offense and defense are a function of strategy, the evolutionary relative to revolutionary approach that a firm may take, risk and growth appetites, and also the relationship that the board and management team have, whether that relationship is more about supervision or more about partnership. We've tried to illustrate these dimensions and also lean into our scope spanning public and private markets by placing 4 types of firms on the spectra: venture stage private companies, buyout stage private companies, closely held public companies, and widely held public companies. I'll emphasize these are approximations. We don't mean for this to be literally exactly the case for each of these firms, but we do think it illustrates the way that the dimensions work and also the way that they change as a firm grows. Let's go ahead and go to the next slide, please. FCLT means for all of our work to be pragmatic and impactful. Edward said that at the outset as well, and we're really proud that this project is one example of that. The example that we're able to put in front of you today comes from Votorantim, a Brazilian member of FCLTs. You can see on the slide in front of you a quote from João Schmidt, Votorantim's CEO. I'm not going to read the entire quote off to you, but I will emphasize the part that's bolded and underlined, where João talks about the way that balancing between short and long-term risk and growth, management and governance can really help the firm perform. Now, in addition to wanting to spotlight a member of ours who particularly leaned into this project, we want to make a point of calling this slide to your attention because Board Playbook provides tools for anyone who wants to take action like Votorantim. So we hope that you'll reach out to us if that happens to be you. There are tools to help make that happen. There you can see the three examples right here on the slide. How do they work? There's questions to ask, and there's menus of answers. The questions are at the board and at the individual director level. And inside the document, there's also menus of practices from different countries. Again, we're leaning into the global scope of this research, and across markets, public and private. Along the way, we did gather a lot of really compelling tips about long-term chairing of a board, and we're excited to also be able to package those up into pro tips for board chairs. With that, I'm going to turn to another project that has information online and more to come. Called Beyond the Blame Game, Why the Proxy System Needs to Change. We're equally excited about this one as the Board Playbook. This publication was released in December. Is part of a multi-phase project. Beyond the Blame Game is our descriptive phase, and there'll be more work coming analytically. It is very specifically and committedly at the executive perspective. We think that's one way in which FCLT can add value, bringing our member CEOs' insights to bear in our research. And the executive perspective on the proxy system has been really interesting. We found that interest in the system has become a lot steadier over the past several years, rather than being occasional, that it is increasingly about the system and not just about the proxy advisors as symbols of the system, and that there's more and more attention to the opportunity that investors and corporations have to influence the system, rather than only frustration with being subject to the system. That said, we do think that a better understanding of it is a precursor to enabling action. I can give a couple of examples. Right now, there seems to be some differing expectations about the system between corporations and their investors. I'll offer three examples. Corporations tend to expect that investors will cast their votes strategically, when in reality, investors have to triage a large number of votes. Companies expect that they will judge the vote on the basis of what it means for the corporate strategy. In reality, investors are voting based on their portfolio strategy. And companies expect that investors value the vote. And what we found in our research is that investors tend more to value having the option of voting. Again, I go through that in some detail because we think that better understanding will enable action by member executives and others. Let's go ahead and go to that next slide now, Ross. A big element of understanding is data. There's three charts here, but really just one point. The time horizon is mostly over 20 years, at least 10 years on the bottom. Over that long-term period, there's been more votes coming specifically from management, not just from shareholders, but they're not producing any more differentiated outcomes. The level of support above 90% is actually increasing not even decreasing. So to unpack that again, kind of say it over, on the top left-hand side, you can see the number of voting items worldwide covered by ISS, one of the proxy advisors, and its increase over 20 years. Top right, the number of votes that management has put forward over that same time horizon. They're broken out, but the headline right now is just the increase. And then on the bottom, the level of support in 4 countries where we were able to get good data. I've talked on several occasions already about how this connects into the CEO perspective, and these 3 slides really encompass something that we heard from our member CEOs at Summit 2025 just a few weeks ago, and that is make better use of our time and of our teams. Let's go to the next slide now. That action can begin now. Folks may not fully understand that because there's so much attention on the regulatory side of proxy voting, and the regulatory side is very, very important. But it is also true that investors and companies are part of the system, not just subjects to it. Before I really walk through the slide, I want to emphasize our highest level goal with taking action is to have a longer term investor corporate dialogue. It's not just to get the so-called proxy plumbing right. That's very important, but we're trying to have a strategic effect as investors and companies in how we engage in this system. That said, as you can see on the slide, investors are the demand signal for the proxy system. And they can make that signal clearer, for instance, through how they disclose their votes and their rationales for voting. Companies, on the other hand, are the supply signal, and they can be more precise with the votes that they supply by engaging proactively with their investors to know what they care about. And when investors have capacity, one of the things that we've really heard repeatedly throughout the project is the way in which capacity is unevenly spread throughout the year, with a crunch time in the spring during voting season, and then more capacity to engage in the fall. Again, the goal here is not just getting the plumbing right. The plumbing is important. The goal, though, is a longer-term investor corporate dialogue. As I said at the outset of this part of the presentation, we are midstream in this research. So we've done the descriptive work now in Beyond the Blame Game. Stay tuned for more, though. Analysis is coming, and we're excited to stay on top of this topic. We do have one more forthcoming project, and I'm going to turn back to Alan He to address this one. Alan, over to you.
Great. Thanks, Matt. So also later this summer, we will be publishing our new research on corporate externalities and carbon pricing. We've entitled this Ahead of the Curve. We know that climate these days can be a bit of a sensitive topic, but undoubtedly it is shaping capital allocation decisions in many companies and sectors, and also just a part of the general equation bottom line wise. We do know, however, that many of the externalities, like carbon pricing, for example, have a major impact on companies' businesses, both for the present and into the future as well. And that's why what we call getting ahead of the curve on these things is so important. It can drive long-term value creation, but that being said, it's easier said than done. There's very few companies that adopt it. Only 14% of the MSCI all-country world actively even have a carbon price, and even fewer in-depth examples exist of how companies are managing this and adapting to it. We've heard from our members through our working groups about its many challenges, that at the heart of it all comes down to the business case. Amid these short-term performance pressures, stock prices, uncertain financial impacts going forward, it's been a hard and long journey for many. Our goal with this project is to overcome these challenges, identify them, and get our members and others to focus on the capital allocation process, to provide examples of how companies are incorporating these externalities. We'll have more solutions for what to do, especially now. As you'll see over on the next slide, part of our attention and really a brief answer of what to do can be summarized by this graphic and its consequences and trade-offs here, as we see with carbon pricing. Companies, if they don't have a view on climate or on carbon, many investments will be made just like they're usually done in the black flat line that we see there. No matter what the price of carbon is, the ROI is going to be the same. But if a company does consider climate, there's plenty of potential for any of these other colored lines, whether that be the red line, the blue line, or the purple line to win out. Or that it could also be a case in the future where that ROI that's consistent with the lines of a black project starts dropping off significantly, especially as carbon prices and regulations are set into effect. As we'll see in our upcoming report, there's still a lot of barriers, as we've heard from our members, to go from that black line to those colored lines. And a lot of companies, well, they're sticking with the black lines. If it ain't broke, why fix it? We're going to adopt a wait and see approach. We'll argue that, well, that's fine for now. It's not enough. We'll really try to draw out the current barriers and obstacles that companies are facing when they're engaging in discussions about this. Hear what we're saying from our members, seeing from our members who are ahead of the curve as examples, and suggest how companies can do so in a meaningful way, whether that's through scenario planning, simulation analysis, broader company engagement, or otherwise. So stay tuned for that. Will be coming later summer. With that, I'll hand things back over to Edward to talk about some other future research.
All right, thank you, Alan. Thank you, Jesse, and thank you, Matt, for your presentations. And before I go into the future research agenda, please, again, if you have any questions on what you've heard thus far, please put them on the chat and also give your ideas when I speak about future research projects, like what is it you're most interested in? Is there a certain priority? So that would be very helpful for us. Now, as I mentioned before, so let's move to the next slide. As I mentioned before, the gold standard is a living product. We launched it not that long ago, and we will continue to update it. Because basically what we do is we look at past research and update that research, but also try to figure out, has that really changed, basically how it filters into the gold standards. So it is a continuous process that we basically with the aim to optimize this product. And the future research agenda, again, is flowing into the gold standard as well. Now, one of the things that we will also start to do is when you look at the gold standard now, it's basically 3 questionnaires. It's very qualitative in nature. What we are going to do going forward is to introduce some quantitative metrics. That is for 2 reasons. First of all, when you have a quantitative metric, it's actually not that easy to game actually that system or that tool anymore because the metric is pretty clear. And the other one, it makes it actually user-friendly. If we can provide you with a metric, the definition of the metric, you know exactly what we're looking for. It's more precise than a more qualitative description. So more to come on that with the gold standard. And then the research agenda going forward is basically based on 2 important themes, which you can see on this slide. You know, what stands in the way of long-term decision-making? Why is it so difficult? And as Alan showed, the data in FCLT Compass shows that actually the investment horizon really isn't that long-term. It's 5 years, and for some groups in the economy, it's even less than that. So the question, like, why is it so difficult, is still very relevant. It's still not there where we think the investment horizon should be. If you go to the next theme, which is really about the functioning of financial markets. And Matt actually told you about the proxy voting that we do. It's interesting that if you think about it, we think that the proxy voting system is actually necessary and it should provide value. But the perception is that basically issuers and investors both find this system actually not efficient. And therefore, it's a question mark. Does it really provide the value that we have in mind? And as Matt said, like, well, we are working on it. We have a first document that is actually describing it, very fact-based. And now going forward, we'll actually work on practical solutions, like how can we make this system more meaningful, more successful. So if we go to the next slide, you basically see a few examples of what we have in mind. And basically what we have here are 4 items that we allocated to the 2 themes. And if you go to the first one, what are the roadblocks? Well, it's employee ownership that we look into. That's also related to board members having or owning equity. You know, what are the incentives? But maybe more interesting is like, how can you put that in place effectively? Because it sounds very obvious, like if you give employees equity in the firm, that is a positive development. It creates loyalty, it creates better incentives. However, other shareholders might be fearful for the dilution of their equity ownership. So it's not as straightforward, and this is one of the items that we're certainly going to look into. As Alan described, we're working very hard on externalities and more specifically the carbon element of it, because that is the most topical of the externalities currently. And then another one is how to deal effectively with activists. We already wrote some papers on activists, and this is a good example. Like we will continue, we will update basically that older paper to see where do we stand now, and how can we actually incorporate the knowledge, the insights that we have with activist research, how can we actually incorporate that in the gold standard? Going to the second theme, the functioning of financial markets. Yeah, we already spoke about this. The proxy system is something that is high on the agenda. We're really gonna work very hard on this one. But another topic is innovation by companies in the public market. There is a perception that actually innovation takes place by companies in the private market. And whether that perception is right or wrong, we will look into it. But suppose it is correct. Suppose this is true. Then the question is, of course, like, well, not every investor has access to the private markets. So if they don't have access to the private market, they also don't have access to innovative companies. How can we change that? How can we make also those investors get access to innovative companies? This actually touches very much on the question, like, should retail get direct access to private markets? And there are a lot of pros and cons in this respect. But it's pretty clear that a lot of GPs are trying to create products where they do give retail access to the private market. And in a way, this also relates to how do DC products actually can benefit from the private markets. We've got very good examples, for example, in the Australian market, where the superannuation funds do invest in private markets, but it will benefit actually the individuals that are embedded in their defined contribution products. So that's another item that we look into. Can we make this a broader thing, or can we actually see how the Australian superannuation funds, if they give us any guidance, how we can make DC products investing in the private markets? And then the last one is, can we come up with a long-term risk management metric that is actually shared by issuers and investors? I think my own experience at PSP and at APG is that this is typically one of the areas where there's a complete disconnect when issuers are talking about risk and when investors are talking about risk. One is really about the business model, oftentimes long-term, the other one is using a statistical, oftentimes very short-term metric. But it is, of course, important when you really want stable long-term relationships between issuers and investors. It's not just the outlook in terms of return and performance, it's also the outlook in terms of what kind of risk profile actually comes with this. So that's another area that we look into. Now, there are three, if we move to the next slide, Ross, there are three important other research topics, but I have to say, we haven't come to a proper research question. I think they're very relevant, and again, your input is very much appreciated. First one is, should we focus more on emerging economies? We have a paper out there, and we just recently published a paper, with all the current uncertainty, what is the role of emerging markets? And one of the things is, going forward, should we emphasize this more or not? The second one, we cannot do it, without. Artificial intelligence is not going to go away. It's very broad, and there's a gut feeling this has the potential to change economic systems dramatically, including the functioning of capital markets. Again, we really feel we have to focus on this, but we haven't defined a very strong or very specific research question yet. And then the last one is what we hear, and this is no surprise given all the political volatility that we see, or geopolitical volatility that we see. Like, what would happen to long-term allocations if the US dollar is no longer the reserve currency? A very relevant question, but again, also a very difficult question. So when we think about these questions, again, I would appreciate if you could give us some feedback over the chat, how you think about these different items. This brings us basically to the last part of the town hall, and that is the Q&A. And let me just say, I saw already some questions popping up. One of the first questions really is for you, Alan, and that is, given all the uncertainty that we face currently and probably going forward, how relevant is the historical data that we get out of Compass for an uncertain VUCA world going forward?
That's a great question, and I think, it really brings up a valuable point. I think at a high level, there's a balance to be struck there. So it's about remembering the past and remembering the trends that we're seeing, but also planning for the future, for that uncertainty, for that VUCA ahead. So we've seen trends over the past 15 years or so of data in Compass. For example, the shift of investing and asset managing from more of a actively managed portfolio to passive. The shift in company composition, as my colleague Jesse mentioned earlier. The rise of the Magnificent Seven. All of those are tech-based, cloud-based computing companies, less so now that the index is comprised of manufacturing companies heavy in CapEx. So all these trends and insights from the past, I would say, feed into future plans and our future research topics and agenda. So we're making sure that it's circular, that it's connected, back to Edward's initial slide on how we do the research, that these are most up-to-date trends that we're seeing, that they then filter and funnel into the research that we're doing, and that we're relying on the members to do these sorts of things. So that's sort of the third leg of the stool here, to make sure that the member inputs and voices are really heard. And in areas that we don't have current data is not up to date yet, we can't rely on historical trends. We'll make a guess, we'll put a hypothesis out there, and it's through interactions like these, it's through our working groups that we really gather data from you, the members, and see if our hypotheses make sense, or if not, what do we need to change? What would we advise? And what would we revise? So it's about consistently adapting to the thing and adhering to that three-legged stool approach to the research.
Thank you, Alan. There is another question that's related to innovation. And what I said, like, we are going to look into innovation in terms of, do listed companies actually innovate? And one of the comments / questions here in the chat is exactly on that point. And I find it's a very interesting statement, and I'm just reading it out loud. The perception that investing in listed companies is non-productive is becoming widespread, and that's worrying for capital allocation and systemic wealth creation. I'm turning to you, Matt. Could you respond? Could you react to that statement?
Sure. I'm glad to jump in. I think, Edward, that you're referring to Stuart Dunbar's perspective from Bailey Gifford. We hear that same concern that Stuart did as well. And Edward, where I'll lean on here is the board playbook research that we just had coming out. One reason why we chose to do that research and we chose to look at both the public and the private company is because we believe that these companies are quite committed to long-term value creation in both markets. And so while the perception is there, and as you pointed out, Edward, we're going to do some research to understand exactly how true or not true that perception is. Normatively, that's not the goal at all. The goal is the inverse. Once listing, to continue to grow. And a way of looking at the research that we've done is as a growth recipe or a growth playbook as well. Of course, when a firm is being born at a venture stage in private markets, it's going to be nearly all upside, nearly all ambition, and that will not remain the way forever. But the idea that public markets are not productive and private markets are, of course, Stuart, understand that's a caricature, but not at all the goal, and not what we found in our research as the goal, even in the boardroom. And so figuring out in that context how we can continue to grow in public markets is already part of our research and something we expect to do more. Last thing I'll say, Edward, before turning it back to you is I appreciate the perspective of the investors in the room in these companies who are thinking about ways in which they can continue to participate in that growth as they move from public to private markets. And that's something that's on our mind as well.
Yeah. Thanks, Matt. Then actually a comment about Gen AI and having an important impact to play in creating foresight toolkits. And that's close to my heart. I think AI personally is one of the topics that is going to influence a lot, having a massive impact on how we work going forward, including capital markets functioning, but also the allocation of capital. For your information, together with Alan, we are spending quite some time on this topic, and like I said, we're trying to come to a proper and precise research question. But maybe Alan, maybe you can share with the group a little bit of the thinking where we currently stand.
Yeah, absolutely. So as Edward mentioned, still a little bit on the earlier side and trying to narrow down a specific research questions. We've been having some conversations with both academics and members alike on what exactly is the key issue, specifically from an FCLT standpoint, as it relates to global cross-value chain, time horizon-wise in that. So a lot of the current ideas when it comes to AI has been focused on point solutions, I would say. A point solution to fix a very specific problem. Slightly less has been focused on a system-wide solution towards certain things, whether that's energy efficiency, whether that's other things. So that's potentially one idea that we had on that when it comes to AI. And then there's other broader ideas referring to things like what exactly is the pain point? Why has adoption not been as fast, as widespread? Is it a matter of a behavioral bias, a status quo bias? Is it something deeper at work? Is it a trust issue? So those are some of our earlier stage thinkings. But again, we'd encourage a lot of conversation amongst our members, participants, and feedback towards helping us refine that specific question on an FCLT angle.
Yeah, thanks, Alan. And basically, it also touches on one of the questions about education and talent development, especially related to AI, where the fear is that AI might actually replace human capital going forward. The whole topic of education and talent development is becoming even more important going forward. So the answer to that question is like, well, we certainly have to look into it as a long-term value creation problem. Like, what is going to change in terms of the human capital going forward? So that's a very relevant question as well. Let me quickly scroll, and I apologize if I miss one of the questions, but I'm don't think I've seen any other questions actually in the chat. There were several questions about the slides. Just to confirm that the slides will be available tomorrow, so you will have them. And I guess on that note, I think we've come to the close of this town hall. I thank you so much for participating, not just listening, being there, but also to put things in the chat. I really appreciate that. It helps us a lot. So thanks again for participating. And I'm really looking forward to see you again in the next town hall or as a participant in our research activities. Thank you so much and have a nice day. Thank you.